ABC Learning looked like one of the safest businesses in Australia. Parents needed it, government helped fund it, and demand never seemed to stop. Then, in 2008, the entire story cracked open. This is Inside Corporate Australia, told through the stories that shaped it. Childcare does not sound like the raw material for a corporate collapse. That was part of the appeal. In the early 2000s, it looked like an almost perfect business. Parents needed it every week. Fees kept coming in. Government subsidies helped cover the cost. And in a growing country with more dual income households, demand kept rising. To investors, that looked close to recession-proof. ABC Learning understood that before almost anyone else. It took a service that felt local, suburban, almost invisible, and turned it into a national growth story. The company began in Brisbane in 1988, one centre, then another, then a larger ambition. And once the market saw the logic, the story became very easy to sell. This was not a speculative technology company. It was not mining. It was not property development sold on a sketch and a promise. It was childcare, a business built around children, working parents, recurring fees, and federal money flowing through the system. That made it feel safe, stable, almost insulated from the usual rules. And that is where the danger began. After listing on the ASX in 2001, ABC Learning expanded with extraordinary speed. By 2001, it had 43 centres. By 2003, it had bought 230 more and agreed to acquire another 40. By late 2005, it had 697 centres across Australia and New Zealand. Then the ambition got bigger. America, Britain, scale. ABC bought Learning Care Group in the United States. It moved on La Petite Academy. It bought Busy Bees in the UK. At home, it rolled through rivals and smaller operators until it became the dominant corporate force in Australian childcare. At one point, the company planned to add 4 centres a week. That is not normal expansion. That is an acquisition machine. And in the boom years, the market loved it. ABC Learning's market capitalisation reached around $2.5 billion in March 2006. Its founder, Eddie Groves, came to represent a very specific kind of Australian corporate confidence, the fast-talking growth executive who always seemed to be one deal ahead. The story worked because it sounded so simple. Demand was real. Government support was real. Parents could not just opt out of childcare because the economy turned. So the market looked at ABC Learning and saw stability with upside. What it did not focus on was the strain required to keep growing at that speed. The official explanation that came later was careful, but revealing. The Senate inquiry said ABC Learning's failure was likely tied to high levels of debt, acquisitions, and complicated business practices. That one sentence explains the entire problem. Because on the surface, ABC looked like a very simple company. Children arrive in the morning, parents pay fees, government subsidies support the system, centres operate. But underneath that simple front, the company was becoming more complex, more leveraged, and more dependent on constant expansion. And there were warnings outside the market too. In 2006, the Australia Institute published a case study on ABC Learning and raised concerns about quality pressures in corporate childcare chains. The Senate inquiry later noted that in 2003 to 2004, ABC spent 56.7% of revenue on staff, compared with an average of 80% for not-for-profit providers. That matters, because childcare is not software. You do not scale it cleanly. It is a labour-heavy business. People are the product. Qualified staff cost money, time costs money, care costs money. And once a listed company starts promising growth, those costs stop looking like the purpose of the business and start looking like pressure on the margin. That was the real tension inside ABC Learning. Was it a childcare company that happened to be growing quickly, or a growth company that happened to operate childcare centres? By the time that question started getting louder, the market story was already weakening. The break came in February 2008. ABC Learning released half-year results showing a 42% fall in earnings. The reaction was savage. Its shares plunged. At one point, they fell as much as 70% in a single day's trading. That was the moment the market stopped treating ABC as a smooth growth story and started looking at it like a stressed balance sheet. And once that shift happens, everything changes shape. Acquisitions that once looked strategic start looking expensive. Debt that once looked manageable starts looking dangerous. Complexity stops looking sophisticated and starts looking like opacity. Eddie Groves blamed short sellers and hedge funds. But by then, the deeper problem was obvious. Confidence had broken. And for companies built on leverage and constant deal-making, broken confidence is not a headline problem. It is an existential problem. Then things got worse. In August 2008, ABC Learning requested a trading halt as it approached its financial reporting deadline. It had already flagged a pre-tax loss of $437 million. Its share price, once as high as $8.80, had fallen to 57 cents. That is the kind of collapse that rewrites the story in real time. Investors were no longer asking how big the company could become. They were asking a much colder question. What exactly had they been funding? In November 2008, ABC Learning entered voluntary administration. At that point, this was no longer just a listed company in trouble. It was a system problem. ABC was caring for around 100,000 children in Australia. It employed around 16,000 staff. It held roughly 1/5 of the long-day care market. That scale changed everything. A normal company can fail and leave losses behind. ABC Learning was different. If it simply stopped functioning, the disruption would land in family kitchens, on commuter trains, in workplaces, and in the daily rhythm of ordinary life. That is why the receivers moved quickly to calm parents. Chris Honey of McGrath-Nicol said local centres would continue to operate as usual. The receivers said the interests of children, families, and staff were central to the process. At the same time, governments had contingency plans ready. Queensland had already set up a task force. Federal ministers made clear that disruption to families had to be minimised. Just pause on that for a second. A private childcare empire had grown so large, so embedded in everyday life, that when it failed, the country could not let it fail in the ordinary corporate sense. That is what made ABC Learning different. It was not just too big for the market, it had become too entangled with family life. And that is when the real meaning of the collapse came into view. This was not only a story about one executive, one board, or one bad set of accounts. It was a story about what happens when an essential service is handed over to the logic of debt, acquisitions, and financial momentum, and then that momentum disappears. In December 2009, a not-for-profit syndicate led by Mission Australia, the Benevolent Society, the Brotherhood of St. Lawrence, and Social Ventures Australia emerged to buy 678 ABC Learning Centres. That detail matters. ABC Learning was not followed by a triumphant turnaround. It was followed by a rescue. The system had to be stabilised. The centres had to keep operating. The structure had to be rebuilt under a different model. Years later, ASIC said it had closed its investigation after being advised there was no reasonable prospect of further criminal charges being commenced. That legal ending was quieter than the collapse itself, but the silence does not make the story smaller. If anything, it makes it more Australian. Because ABC Learning did not collapse in one dramatic instant. It collapsed the way many dangerous corporate stories end. First, the market falls in love with growth. Then it ignores the strain underneath it. Then confidence breaks. And only after the damage is done does the whole thing start to look obvious. ABC Learning was built on an assumption that sounded almost impossible to challenge, that childcare was too essential to fail. But essential does not mean safe. Demand does not protect a company from debt. And a business does not become sound just because families depend on it. What failed here was not just a childcare empire. It was the belief that something socially necessary could be rolled up, leveraged, financialized, and stretched, without eventually exposing the people beneath it. And that is why ABC Learning still matters. Because the collapse was never only about childcare. It was about what happens when the market mistakes necessity for safety. Every company has a story, but not all of them are told. Some rise, some fall, all leave a mark on Australia's corporate landscape. This is Inside Corporate Australia, told through the stories that shaped it.